Willy Woo on this idea of, derivatives and spot price. He was really kind of hammering home this idea that he thinks the price of Bitcoin can be controlled by derivatives. What is your response? And I saw you guys going back and forth, and I was also involved there a little bit. And Dylan, just for being open with the audience, you and I agree on this versus Willy. But what's your point of view as you would respond to Willy, who's saying that he thinks derivatives can kind of wag the tail of the spot price?
Yeah, there's I think a few different camps or maybe subsectors of the futures argument. One is kind of the gold bugs who are saying, well, look we have this hard money asset, and for 20 years, 30 years, forever, as we've been investing in it, it's then manipulated. And they point to the JP Morgan, guys getting fined and fired and all of that, and the settlements there. And it's see, we told you, they're manipulating the futures market and putting a lid on the price. Mm-hmm. And it's well, yeah, because there is no spot gold market. Well, why is that? Because you can't physically settle gold instantaneously. I can't buy gold on an exchange and withdraw it in 30 seconds. And I do that with Bitcoin, a few times a week. And so there's that component. The futures market, whether it's for gold, it's a calendar's future, mm-hmm. Right, next month, next week, whatever. Where for Bitcoin, there's spot market and there's also a futures market. There's calendar futures, but more particularly, there's the perpetual future, mm-hmm. which never expires and just rolls over. And so to break it down, if you had said, well, the futures market is either artificially inflating the price or suppressing the price, there's a few things to consider. One, for every long, there's a short, right? Two, there's a dynamic financing rate or funding rate, as it's technically called, in this market that references the spot market price. So say spot Bitcoin's trading at 35,000. If the futures market's trading at 34,000, there's an interest rate that the people on the long side of the trade are getting paid to buy it. So if you buy this contract and hold it, you're receiving every 8 hours an interest rate. And that interest rate is calculated based on where the price is relative to the spot market or the spot reference rate. So what does that mean? Well, essentially, you're getting, if the price is too high compared to spot market or too low, you're getting the longs are directly paying the shorts, or the shorts are directly paying the long. So any derivative dislocation you see in bull markets, it often happens to the upside. There's a ton of speculators, everybody's going long, they're using Bitcoin as collateral, dollars as collateral. There's a frenzy, it's a mania, and that often resolves in dramatic deleveraging events. Mm-hmm. Versus say December of 2022, it was the opposite, and the spot market price and the price on CME futures was actually under the futures market was under the price of the spot market. So you were actually paying to go short Bitcoin. The shorts were paying the longs, and all of those people got blown out of the water, right? So the notion that Willy says that you can suppress this price on a long time frame is, in my opinion, wrong. The one thing that to consider is this goes out the window if there's an exchange that's not operating fairly, right? And in that case, the solvency of the exchange or the legitimacy of that exchange is in question. It's not a matter of if the futures market itself is suppressing the price. So with SBF, right? They're well, look what happened with Sam. It's well, yeah, he was leveraging his solvency to cap this thing, right? Mm-hmm. It wasn't the futures market itself that was acting as the mechanism, because that's very much self-correcting. So I don't know if that made sense or not, but that's my 2 cents.
Because at a certain point, there are exchanges that are allowing people to withdraw Bitcoin because they're operating ethically. And it just becomes so obvious because we can audit on-chain data that if there was a really bad actor, let's say backed up by a sovereign entity that was allowing them to manipulate it through derivatives, that it would eventually manifest itself because there'd be so much coin consolidation of people that are acting in the rest of the global economy network that it would become obvious that, oh my God, there's 95% of the coins haven't moved in the last, year. Like, how in the world is this price doing this kind of situation? And I think it would point to the exchange that would have been manipulated. And then it really gets the cascading event that would materialize out of that would be quite phenomenal to watch. And I'm not saying that's what I think's happening. I'm just saying I think that that's on a long tail. If that was the scenario playing out, I think it would still manifest itself as a free and open market that would demonstrate the truth.
I think there's also another important point, and it, like a lot of people, I think, if you're not following these markets closely, don't realize this. Like, there isn't a Bitcoin price. There's 100 Bitcoin prices on 100 different exchanges, and obviously some are bigger than the others. But let's say on FTX 2.0, right? there's someone out there that's maybe backed up by government, or just a whale, or someone in big bank that wants to suppress this thing and not let it rip. Well, you're gonna see that, right? You're gonna see that on FTX 2.0, the price of Bitcoin is 34,000, while on Binance and BitMEX and Coinbase and XYZ exchange, the price of Bitcoin is 35,000, 35,500. Like, you're going to see the discrepancy, whether that's the futures market or the spot market, and there's going to be a flow of coins, whether it's withdrawing from one exchange to the other, right? You're going to see that be arbed away. And so at a certain point, the person that's trying to suppress this thing, right? Like, you can get away with a good trade, right? But if I'm sitting here and the price just keeps bidding up, and every single time I'm short, I'm selling. Well, it's like, you're trying to suppress a beach ball underwater at some point, and you're going to get blown out of the water. Like, no one has infinite Bitcoin denominated capital, right? So that you're going to get checked, you're going to get called on your short position, or if the exchange is operating in such a manner, the exchange solvency is going to get called into question. So that's where I disagree, and the futures market and the spot market are very much intertwined. But on a net basis, futures, right? Like, if I buy spot, I never have to sell it. Like, I'll probably sell some spot at some point, right? But I buy spot, I send my Bitcoin to my cold wallet, cold storage, right? If I enter a long position, or if I enter a short position, at some point in the future, I have to close it. I can never just log off and never, there's always a net negative or net zero effect, net negative if you account fees. So again, this is where I think it's a nuanced debate or conversation, but because of the instantaneous settlement of it, because of the fund of flows, because I can buy and settle immediately, it's quite different than, let's say, a gold futures market.
Very much so. I completely